Hi, my name is Lisa Cummings, and today I'm going to share with you some information about cash balance plan design. First, I'd like to share with you some information about our firm. Our firm is Cummings and Cummings Law. Our website is www.cummings.law. We assist businesses as well as individuals with full service legal representation. We assist both businesses as well as individuals with retirement plans and retirement planning, including full tax support as well as real estate and business transaction services. Now, a little bit of information about me. I have spent my career working with large companies, assisting them with establishing retirement benefit programs as well as compensation and executive compensation needs in a legal perspective. Today, I'm going to share with you some information specifically about cash balance plan and certain design decisions that you need to make if you're an owner of a company and you are working to put in place a cash balance plan. Today, I'm going to share with you first a refresher of a cash balance plan and how it can enhance your existing 401k plan. Then I'm going to share with you some of the plan design decisions that you can make about your cash balance plan. First, a refresher, some quick cash balance plan definitions. A 401k plan is a defined contribution plan. Employees can defer compensation, and the employer may also add matching contributions or profit sharing. The participant's retirement outcome depends upon contributions from the employee, sometimes also from the employer, as well as the underlying investment performance of the 401k account. To contrast that, a cash balance plan is a defined benefit plan, a pension style plan, but it is presented in an account-like format. Each participant in a cash balance plan has a hypothetical account that receives a pay credit, which is usually a percentage of compensation or a flat dollar amount, as well as an interest credit, which is a stated rate that is defined by the plan. The cash balance plan is typically funded primarily by the employer as opposed to the employee and requires actuarial calculations and an annual funding analysis. So if you remember one thing, remember a 401k plan is the flexible, familiar savings platform, whereas a cash balance plan is the pension engine that can often allow larger deductible contributions when the underlying demographics of that particular organization fit. So first, let's talk a little bit about how actuaries think about cash balance plan. Actuaries are individuals who spend their lives thinking about the overall financial impact of a particular financial situation and then projecting the likelihood of a particular event to happen, taking into account multiple different scenarios. Within a cash balance plan, actuarial calculations can be made simple if you can think about the fact that the actuary is going to be looking at contribution ranges by employee. They're also going to be looking at interest credits for those employees. And then they'll also be thinking about age-weighted credits. So something to think about is that for a cash balance plan to make sense for an organization, there has to be a significant difference between what the owners or those at the top of the organization actually earn compared to the staff of the organization. Additionally, the actuarial will be taking into account things like what is the plan definition of an interest credit versus what is actually earned by the underlying assets. And then the actuarial will also take into account the demographics or the age of each of those participants, because the age of each participant can determine how much of a benefit can be set aside for them within a cash balance plan. So the cash balance plan is not a real account. A cash balance plan is truly a type of a defined benefit pension plan. That means the cash balance plan is not funded like a 401k plan where contributions are simply whatever you decide to put in up to a limit. Instead, the cash balance plan promises a benefit, and the contributions are whatever is needed within a range to fund that promise under the actuarial rules. Participants will receive a hypothetical account in a cash balance plan with two separate moving pieces. One is a pay credit, which is often either a percentage of pay or a flat dollar amount. And then, secondly, an interest credit, which is a stated rate that is used to grow the hypothetical account each year. Even those statements look like a balance. The pension plan is still governed by defined benefit funding and actuarial assumptions. There are three separate actuarial elements that we have discussed. First is the employer funding, which is going to be determined by the actuary, and that funding is what will allow the pay credit to be funded. So this is where the plan formula will add a flat dollar amount or a percentage of each individual's pay. And then there is also this element of the interest credit, which is defined in the plan to provide on an annual basis to each plan participant a hypothetical account balance. So the statement that each plan participant will receive conceptually will reflect their ending balance as of a certain date of the current year, which is equal to whatever the beginning balance was at the first of that year, say, and then adding on the pay credit, which is the employer contribution for that particular employee, and then adding on the interest credit. So, how the actuarials go about determining the correct amount of the contributions? They actually are backing into the funding, the employer funding, which will be needed so that over time the plan can deliver the promised benefit, typically at retirement age. Here is the intuition. The plan promises at retirement age that you will have a certain cash balance. Each year, the plan will add a pay credit and an interest credit for each plan participant. And the actuary will calculate the present value today of what must exist to meet that future target using actuarial methods. In practice, you will hear about a contribution range. That employer contribution range exists because funding rules allow a certain amount of flexibility year to year, and also actual underlying investment results can vary based upon employee changes, compensation changes, interest credit changes, and so on. And then also the plan often aims for a funding corridor. In other words, funding from X dollars to Y dollars, as opposed to telling the employer you must fund exactly Z dollars. So instead of you must contribute exactly a certain amount, it's more like based upon the plan design, the plan participants, their compensation, the underlying earnings of the trust investment, which is where prior employer contributions have been invested. You can generally contribute between $A and B this year. So for example, the pay credit for an owner, so this is an owner as opposed to a staff employee. Here, an owner employee, let's say the plan's formula gives the owner a pay credit of $150,000 for the year, plus interest crediting. The actuary may determine that depending upon timing and assumptions, an appropriate contribution might be $140,000 to $170,000 for that year. The range isn't guessing, it reflects the funding rules and the mechanics of meeting the promised benefits over time. And then in each particular situation, there will have to be for every participant a similar pay credit. Also, In aggregate, it is the employer that must fund for all of the underlying employees on an annual basis. So interest credits, what they are and why they matter. This is one of the most misunderstood parts of a cash balance plan. The plan document must specify a specific interest crediting rate. For example, a fixed rate like 5% or a variable rate that is tied to an index, commonly something like a treasury-based return. This interest credit is part of the benefit formula, not the investment return. The trust actual investments can and most likely do perform differently. So here's the key point to remember. If the plan credits participants 5%, the plan must be able to support the promised growth in the hypothetical accounts. If the investments earn more than 5%, the plan may build a cushion. If the investments alternatively earn less than 5%, the employer may need to contribute more over time. So the interest credit choice affects both risk as well as contribution stability. Think of interest credit like the plan's internal growth guarantee for the statement balances. The actuary helps design that particular interest credit so that it is compliant and manageable. Age-weighted benefits. Why older employers can have their business contribute more. Now the big question, why do cash balance plans often allow much larger contributions for older employers? It comes down to time. If two people are promised the same retirement age benefit, but one person is 60 and the other is 40, the 60-year-old has far fewer years to fund that promise. So annual required funding for the 60-year-old in this example is generally higher. In a cash balance plan, pay credits can be designed to be uniform so that all participants have exactly the same percentage of a pay credit or the same flat dollar amount, or the cash balance plan can adopt age-weighted or otherwise structured to produce benefits that meet business goals and ensure IRS non-discrimination requirements. But the core actuarial reality remains. Less time to retirement means a higher annual funding capacity for the older aged participants in the plan. They will be receiving the same target benefit, however, they have fewer years to fund, and as a result, a higher annual contribution for older employees is required. Age-weighted benefits. Here's a simple example for you. Imagine a target retirement plan benefit that equates to a hypothetical account of $1 million at age 65. If the participant in question is a 40-year-old, that individual has 25 years of pay credits and interest credits to build toward that amount. However, if the individual is 60 years old, they only have 5 years. So even without complex math, you can see why the 60-year-old's annual funding amount must be much larger. This is why cash balance plans are often especially attractive for business owners in their late 40s, 50s, and 60s who want to accelerate retirement savings and deductions from their business. But they must be designed carefully because staff benefits and non-discrimination testing for the IRS really matter. The IRS will ensure that all federal tax laws are followed. So here is another snapshot of looking why age-weighted benefits matters, or stated differently, why time to retirement matters. Here you can see that we have a participant who's age 40. They have 25 years to reach age 65. So the company funding on behalf of this participant A, who's only age 40, doesn't have to set aside as much or contribute as much to the cash balance plan for that younger participant in order to fully fund the benefit at that participant's retirement age. Compare that to participant B, who is age 60. Here you can see the employer will have to fund the full amount within a 5-year period of time. This takes into account that additionally, the plan must also follow IRS funding requirements and design requirements to ensure that the plan participants are treated equitably within the requirements of the IRS. So let's talk about some practical next steps. Let's wrap up with some practical takeaways. Contributions are actuarially determined and usually are delivered as a range, not a single fixed number. Interest credits are part of the benefit formula. They will influence funding volatility and employer risk. And then age weighting is driven by the participant's time to retirement. Older participants can often support much larger annual contributions because the plan has fewer years to fund the promised benefits. If you are evaluating a cash balance plan, ask for these items up front. One, what is the interest crediting rate and how might it affect future contributions? Two, what is the expected contribution rate this year and over the next few years? And three, how does the design handle owners compared to staff and what testing constraints apply? These elements will be considered when you choose to undertake a feasibility analysis. If I may provide you with any additional information, please feel free to email me, lisa@cummings.law. Thank you so much for joining us today.